Hello everyone, I'm Amit Parakh representing Finstudyclub, and as part of our initiative to help the students who would be writing the exams in another couple of weeks, here I come up with the 5 key questions, or may I say the 5 key concepts that one should be aware of before they step into the exam hall. And this session is with respect to derivatives. So let's get started. So there we have question 1, and may I read that? The finance manager of the company is expecting an inflow of $25 million in 60 days. He is expecting a decline in interest rates in the near term to protect against the risk, and this is basically the interest rate risk. He takes a position in an FRA based on 90-day LIBOR quoted at 5% and that expires in 60 days. On expiry, LIBOR is 4%. So what are we supposed to find out? What should be the notional principal? What should be the position in FRA, long or short? What is the type of FRA used here? And what is the gain or loss to the company? So the finance manager, of course, is representing some company, and hence we need to find out the gain or loss to the company. Now before we get started, I think just one caveat. Now this is not the format in which you're going to get questions in your level 1 exams. All of you would be aware that the questions would be in the form of MCQs, but here the intention is to make you familiar with the concept, and hence very deliberately I've tried setting up questions without the options, so that while we discuss these questions you should get a better sense of the overall concept. Alright, so let's get back to the question. So here the finance manager, may I say the company, is expecting an inflow of $25 million in 60 days. So if I'm supposed to receive a certain fund, my next step would most likely going to be, how am I going to park those funds? So very obvious that the manager is concerned about a possible decline in interest rates by the time he would be receiving these funds, which would possibly force him to park his money at lower rates, and that is what he would look to protect himself against. Now when I say he, it's essentially the company. So the finance manager out here represents the company. So he should be taking a position in FRA. Now what kind of a position should he be taking in FRA, and which is based on a 90-day LIBOR quoted at 5% and that expires in 60 days. On expiry, the LIBOR is 4%. So let me very quickly explain you what FRA is. I'm sure most of you would be familiar with it, but just a quick reckoner. So the company is going to receive, so we are on day 0, here we have day 60. This is when the company is going to receive $25 million. And then given that he looks to park that money for a short while, because he's more concerned about the decline in interest rates over the near term. So a possible explanation or could be that he would look to park this money for, let's say, around 90 days. Alright, so that makes this D150, which is D60, 60 plus 90, 150. So this is the period over which he looks to park the money, which is over 90 days. So what kind of an FRA should one be taking? Now clearly the kind of FRA that one should be taking, now we all understand what is an FRA. An FRA is basically a forward agreement where the underlying is a prospective loan. I repeat, an FRA is a forward agreement where the underlying is a loan, a prospective loan, which will kick in at a certain point of time. Now this is an FRA which expires in 60 days. It means that the underlying loan would kick in 60 days from now. So this is precisely the point when the underlying loan kicks in, and this loan is based on 90-day LIBOR. So they're talking about a 90-day LIBOR. So clearly the FRA serves the purpose. Now given that the company is looking to lend money, we need to find out what should be the appropriate FRA position. A long FRA means borrowing money on a prospective basis, and a short FRA means lending money on a prospective basis. So that kind of gives you the answer that the company should ideally be taking a short position. What's the type of FRA? We need to know the convention by way of which we represent FRA, and what's the gain or loss to the company. That's something that we would try to calculate based on our comparison between the FRA rate, which is 5%, and finally what the LIBOR turns out to be at this point of time. Okay, so let's see, let's answer all these questions one by one very quickly. So what should be the notional principal? Well, it should be $25 million, isn't it? Because that's the kind of inflow that the company is expecting. That's the kind of money that they look to park at the time when they receive this money, and hence that should be the notional principal for the FRA. Alright, so this is quite an easy answer to an easy question. So let's look at the second question, which is what type of an FRA is being used here. Well, it's a 2x5 FRA. Now why do I say it's a 2x5 FRA? Well, this is an FRA which where the underlying loan kicks in 60 days from now. So the FRA expires on day 60. That's what the question says, and the underlying of the FRA is a 90-day loan, a 90-day LIBOR. So one would say that this basically is 2 months and this period is 5 months. So the way to represent or let's say describe the FRA would be that it's a 2x5 FRA. It's an FRA where the underlying loan comes into picture 2 months from now and terminates 5 months from now. So the 2x5 in a sense positions the underlying. Where is it? Where, in what, over what timeline does it exist? So it's a loan which kicks in 2 months from now and terminates 5 months from now. Alright, so that's how we describe the FRA. Now move on to the next question. What should be the position in FRA, long or short? Now from a company's perspective, a short position is what it would be taking, because that is similar to lending on a forward basis, and hence for the company it would be a good hedge against a short-term decline in interest rate. So what's the gain or loss to the company eventually? Now let me draw this. So it helps drawing the timeline. So here we are, day 60. The FRA rate was 5%. So the company locks in its lending rate at 5%, but eventually the rate turns out to be 4%. So you would say, well, given that the company has taken a short position, that means it has kind of locked itself into a lending rate of 5%, and if the actual lending rate turns out to be 4% at that point of time, the company is better off, because the FRA has effectively given a 1% advantage to the company. Now this 1% advantage translates into what amount of dollars? Let us see that. The notional principal was 25 million. Now thanks to the FRA, the company would get 5%, but the actual rate is 4%, so there is an advantage of 1% for the company. So that's 4% minus 5%, 1%. But then this is a loan for 90 days, so this 1% effectively gives an advantage of 1% into 1 by 4, which is 0.25%. So we calculate 0.25% of 25 million, and that's a kind of incremental cash flow that kicks in at D150. So the present value of it at D60 will be 1 plus whatever is the prevailing rate into 90 by 360. So it's as good as saying that thanks to 5% at D150, I would be getting 25 million plus 5% of 25 million, or may I say 1/4 of this, because it's for 90 days. So 1.25% of 25 million. But the actual rate, if somebody were to go by way of this, he would be getting 25 plus 1% of 25 million, isn't it? So the advantage is 0.25% of 25 million, and this is the advantage that comes into play at D150. So what's the present value of it? There we find out the present value of it by discounting it appropriately. This gives an advantage of 61,881. While it's a negative for somebody who's taken a short position, this translates into a gain. So therefore it's a gain for the company. Okay, so that I believe should now make you comfortable enough with FRA. Let's now look at the second question. So there we go. The current future price is $106. The initial margin requirement is $10. And the maintenance margin is $8. One has gone long 10 contracts of futures and meets all the margin calls, however does not withdraw any excess margin. Now the prices on the following days happen to be 105, 107, 105, 104, 105 and $102. So at the time when the person takes a long position in the future contract, it takes it at 106, but subsequently prices go up and down. So we need to identify the margin calls, when would they take place, the timing of it, and what is the total gain or loss by day 5. That's what we need to calculate. So let us see. So for your convenience, I've drawn the table so that it helps us understand initial margin, maintenance margin, and how margin calls gets triggered and how mark to market happens. So there we are. On day 0, when the future price was $106, that's when he took a position, and that too in 10 contracts. Now the initial margin requirement was $10 per contract, so on 10 contracts he would have apparently paid $100. So that's the deposit amount. Now day 1, the prices go down by $1, so it's 105. So there's a price change to the extent of -1, so leads to a mark to market debit of $10, so his deposit would come down to $90. Well, it is still above $80, still above $8 of maintenance margin, and so, well, there's no panic. So day 2 carries forward the margin balance $90. The prices go up by $2 and hence another $20 kick in, so it becomes $110. So eventually day 3 the prices crash by $4 and hence there's a $40 debit from the account and hence it reduces to $70. Now this $70 is would result in breaching of the maintenance margin level, which should be $80, right? 10 contracts, $8 for each contract, so $80 should be the minimum amount of money at any point of time, and hence $70 would mean the violation of the maintenance margin level, and hence it would trigger a margin call, and the concerned person would be asked to deposit, replenish the margin account to the extent of the initial margin requirement. So $70 being the depleted amount, so $30 is what would be asked to be brought in by the long position holder, so that again you have the margin level being brought back to the initial margin requirement, which is $100. So then you have the price of 105, $2 kicks in, and there you have $120. So that is what it's going to be in day 5. $3 decline price, loss of $30, and hence margin finally stands at $90, the total amount in the margin account. Now what is the cumulative loss or gain by day 5? One can easily aggregate this. So -10 plus 20 is 10, minus 30, minus 10, minus 40. So net there's a loss of -40, which can very well be explained by looking at the price at which the person went long. It was 106, and by the time when we are looking at things, or we are trying to take stock of loss or gains, the price is 102. So there's a decline of $4. $4 into 10 contracts makes it $40. So $40 will be the cumulative loss. And when does the margin call trigger? We can easily see that it triggers at the end of day 3, right? That's when the margin level is breached. So I hope everyone's clear with how the margining system works. So let's now move on to question 3. Now this is on options, quite an important concepts within options. Let's go through it. European put and call options with an exercise price of $50 expire in 3 months. Underlying stock is trading at $46. Risk-free rate is 6%. The put is trading at $7 and the call is trading at $4. So compute the mispricing based on our comparison between the call price and the synthetic call value. So we'll see that how to arrive at the value of synthetic call based on the put call parity rule, and then try to compare the call and the synthetic call value and see if there is a scope for arbitrage, which is basically what the second question is. Suggest an arbitrage strategy to exploit the mispricing. So this entire question is based on put call parity. Alright, so quite an important concept, guys. So I would strongly suggest that you should be well versed with put call parity. Now please remember, this put call parity is applicable for European options and not for American. So there we have the put call parity, which is P plus S is equal to C plus the present value of the strike price. Alright, so I shall make C the subject. So it should be equal to P plus S minus present value of the strike price. So there I substitute the numbers. The put premium is $7 currently, stock currently is priced at $46, and the present value of $50, which is the strike price. Now it's a 3-month expiry options that we are talking about, so I find out the present value of $50 discounted at 6% for 3 months, which would nearly approximately, I've just taken an approximate figure, it would basically mean the present value being 49.25, which approximately gives me the call value to be 3.75. So the synthetic call should be the synthetic call is valued at $3.75, thereby making the call an overpriced option. So we realize that the market price of the call is $4, while the value of the call based on the put call parity, which we term as the synthetic call, is being valued at $3.75. So one would suggest buying the synthetic call because it's trading cheap, or it's valued lower than what the market value of the call is. So I'm going to sell the call in the market and I'm going to buy the synthetic call. So I'm going to go long this, so indirectly buying the call by buying the put, buying the stock and selling the bond, and at the same time selling a call. So my strategy is going to sell what is expensive. So I'm going to sell the call in the market at $4 and I'm going to buy the synthetic call, which would mean I shall buy the put, I shall buy the stock, and I shall sell the bond. You have a negative sign over here, that means you're going to sell the bond, and selling a bond means borrowing money. I think this is something that you should know. Selling the bond means borrowing money, buying the bond means lending money. So I'm going to borrow money and I'm going to sell the call. So that's what your arbitrage strategy would be around, which would help you make $0.25, which is the difference between $4 and $3.75 on every single position that you take. Now kindly keep it in mind that this entire strategy that we are laying out, arbitrage strategy that we are laying out, and the gain that we are indicating is based on the assumption that there is zero transaction costs. So once you have the transaction costs coming in, once you have the bid-ask spread which is being faced by you, the execution of the strategy might not be as easy as it seems like from the given discussion. Okay, so there we have question 4. I'm not going to take too long I think you should be back to your preparation. So let's just very quickly look at the penultimate question before we move on to question 5. So John has bought stocks of BBY at $20 per share. He's contemplating creating one of the two positions, buying a put with the strike price $18 at a premium of $1.2. So John already has a long position in the stock and he looks to buy the put of the same stock with the strike price $18 at a premium of $1.2 now. Or alternatively, he looks to sell a call option with the strike price of $22 at a premium of $1.5. So John makes two statements. Statement 1, the put option would result in limited losses. Statement 2, selling a call does not limit the gains. Comment indicating the upsides and the downsides in the option position. So what do you think? When I buy the stock and I buy the put, what kind of strategy is it? Just pause for a while, think of it. What kind of strategy is it? You would say, hey, that's a protective put strategy. 2, I have the stock, I sell a call. What kind of strategy is it? Well, you would say it's a covered call strategy. Alright, so there we have these two strategies and John is looking to execute one of them, and there are of course pros and cons of these strategies. So let's try and evaluate those. So strategy 1, John has the stock, so he's gone long stock and he's gone long put. That's a protective put, and we all understand that a protective put strategy would result in limited downsides and unlimited upsides. So without really graphically trying to plot it, let's see. John has gone long at $20 per share. Alright, now if he buys the put with the strike price $18, that means he's protected for any price decline that would happen below $18. So the maximum loss that he would have to face on account of the stock price decline would be $2 based on this, right? Because below $18, the entire decline in prices would very well be insured by this put. So this $2 is the maximum loss the guy can face. Now, not to forget that he spent a premium of $1.2 in buying the put, so that's again a cost. So net his total maximum loss could be to the extent of $3.2. Alright, so the payoff, the negative payoff that this strategy would bring in would be minus $2 or $2, whichever way you would want to put it. So the negative payoff is going to be $2 and the net P&L maximum loss could be $3.2. What about the upsides? Well, you would say, well, the upsides are unlimited. So in case if the stock price were to reach $30, the guy ends up making $10 on the stock less the premium. Still it's $8.8. So well, it's all a function of the stock price. To what extent can it move up, and depending upon that, John is going to have substantive profit. Now what's going to be the break-even point? Now you would reckon it should be $21.2 because he would be making $1.2 on the stock, only to be set off by the $1.2 premium that he spent on buying the put. Alright, so there are limited downsides and unlimited upsides. So I think we would absolutely be in concurrence with what John is saying, that the put positions would result in limited losses. Alright, so let's look at the next strategy which he's exploring, which is buying the call. So he's I stand corrected, selling the call. So I'm long stock and I sell the call. Long stock, short call. Well, that's a covered call strategy, and a covered call strategy results in limited upsides and unlimited downsides. How's it so? Let's look at it. The concerned individual has sold a call option with the strike price of $22. So may I say, well, from $20 to $22, the gain is all his. The gain is John's. But beyond $22, any price rise, the gain would have to be passed on to the call buyer. So the maximum money that he can make on the stock is $2. The rest of it needs to be passed on. Now, not to forget that he's received a premium of $1.5, so his net P&L could be potentially $3.5. So you would say the maximum gain on this strategy is $3.5. What about the losses? Well, the losses could be unlimited. In case if the stock were to go down, and let's say go down to $10, he loses $10 out here. Well, he gets compensated only to the extent of $1.5, the premium that he would have received. So still the loss is huge. So one would say there would be limited upsides and unlimited downsides. So that's a covered call strategy. So how do we evaluate the two statements? Well, the first statement is true. The put position would result in limited losses. The second statement, which is selling a call does not limit the gains, of course it does. We did see that, isn't it? So the first statement is true, the second statement is false. Let's now look at the last question, and what I've done is I've tried punching in quite a few concepts in the last question. So you might very well complain that this question looks to be a set of questions. Well, the idea out here is to just bring in some very, very important concepts which I think are testable areas for your forthcoming exams. So there we go. John, a student of financial derivatives like most of you, makes the following statements. Now, these are the statements being made by John, and who is a student of financial derivatives. So we would reckon that most of these statements should be true if we studied the subject well. Statement 1. Futures and forwards otherwise alike could be priced differently depending upon the nature of the underlying. So that's statement 1 from John. Statement 2. An arbitrage strategy between FRA, which is forward rate agreement, and synthetic FRA is possible if there is mispricing. Now, generally when there is mispricing, it does throw a scope for arbitrage strategy. Let us see if one could execute an arbitrage strategy between an FRA and synthetic FRA, and this is quite important, synthetic FRA. Statement 3. An American option, be it put or call, could be more valuable than European option. Well, generally, while they are quite close to each other, there could be situations where an American option could serve a significant advantage over the European option, and that's when it would be valued a lot more. So we need to provide the rationale behind each of the above statements if true. Now I would reckon that all the three statements are true, and let us evaluate under what circumstances would they really play out, each of these statements. So let's take them one at a time. So statement 1, futures and forwards otherwise alike could be priced differently depending on the nature of the underlying. Well, try and recall. Well, if the underlying tends to have some kind of definite correlation with interest rates, that could throw up the possibility of futures and forward pricings being different. So how would it work? Well, the way it would work is that let's have a future where the underlying is, let's say, something like a bond. So I'm talking about an underlying which is a bond, and we all understand that bond tends to have an inverse relationship with interest rates. Alright, so that means when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. So what I have done is I've taken a long position on a bond future. Now what I see, a future being an exchange traded derivative would have its own margining system. There would be cash inflow and outflow almost on a daily basis. So let's say if interest rates go up, that would result in bond prices going down, that would result in bond futures going down. So the price of my futures would go down, and that would result in cash outflow. Alright, so I have cash outflow when interest rates are rising, and when interest rates go down, that's when prices go up. So when interest rates go down, so this happens when interest rates are rising. When interest rates go down, that is when bond prices would go up, and that's when I would make money on my futures, and on my long position in future, then that's when I would have a cash inflow. Alright, now while I don't mind cash inflow, overall this is not a great situation to be in. To have cash outflow in conjunction with rising interest rates makes my borrowing cost much higher than my lending cost. So as somebody who would be inclined towards taking a long position on a derivative where the underlying is a bond, I would prefer a forward to a future, because a forward doesn't really have mark to market practice, and hence there would not be any cash inflows or outflows. So given a choice between future and forward, I would go for forward, right? I might be willing to pay a slight premium as far as the forward is concerned, so that creates a situation where the future price could actually be lower than the forward price, and that would happen when your interest rates and the underlying of the derivative of the future and forward are inversely related. So I hope this is clear with everyone. Okay, so quite true, quite true. So depending on the nature of the underlying, its relationship with interest rate, the future and forward prices could be different, could very well be different. Apart from some other factors, I think this is one factor that you guys need to be mindful of. So let's look at the second statement which John makes, and that's an arbitrage strategy between an FRA and synthetic FRA is possible if there is mispricing. So when would this happen? Quite possible if the FRA rate is not equal to the forward rate implied from the existing spot rate. So let me try and explain it by way of a very simple example. So let's say this is D0, this is D90, and this is D180. So day 0, day 90, day 180. Now I look to enter into an FRA which is a 3x6 FRA. Alright, so that's an FRA which expires here and where the underlying loan is for this period. Alright, and this FRA is available to me at 5%. Great. Now let's look at what the prevailing interest rates in the market are. Let's say a 90-day LIBOR is currently trading at 4%. So you have a rate which is basically applicable for this period, alright, and this is 4%, the 90-day LIBOR. The 180-day LIBOR is, let's say, 8%. So then, and please remember, the LIBOR rates are always the annualized rate. So a 180-day LIBOR is 8%. That means this rate is 8%. A 180-day LIBOR is available at, let's say, again 4%. I'm sorry, not 8%, but 4%. Okay, so these are all annualized rates. Now you would say, well, if the 90-day spot rate is 4%, the 180-day spot rate is 4%, then what shall be the 90-day forward rate 90 days from now? Now we all know how to calculate the forward rates. A quick arithmetic approximation of it would be the effective rate for this is 1%. The effective rate for this period is 2%, right? 4% by 2. So 2% minus 1%. The 1% should be the effective rate for this period, which means the forward rate out here, the implied forward rate out here is 4%. Now you would say, hey, by way of this FRA, I'm able to capture an interest rate of 5%, while this forward rate basically implies that the expected rate over this period is 4%. So there we have a scope of arbitrage. Now how do I exploit this arbitrage? So please remember, an arbitrage would be possible if there is a discrepancy between the implied forward rate and the FRA rate. So clearly there is a difference. Now how would I exploit that? Let's see. So let us see. Now given that FRA gives me a better rate, you would say, Well, it makes sense to go short FRA, because going short FRA means prospectively lending at 5%. So that's one leg of your arbitrage strategy. I'm going to go short FRA. Alright, now if you're going short FRA, you need to go long synthetic FRA. That means I'm going to borrow money at 4%. Now, how do I effectively borrow money at 4% for this period? For this period, I need to borrow money. So B for borrow. So how do I create that? Now you would say, hey, why don't you borrow for 180 days and lend for the next 90 days? That effectively creates a forward borrowing for the next subsequent 90 days. So that would mean I'm going to borrow money for 90 days, borrow money for 90 days, or rather 180 days, and lend money for the next 90 days. Okay, that's what we are going to do. So I'm going to borrow money for 180 days at the LIBOR rate of 4%. I'm going to lend the same amount of money at 4%, which is the 90-day LIBOR for 90 days. And moment I get back the money at the end of 90 days, well, I do have the FRA by way of which I would be able to capture another 5%. So so that will help me create a scope for making money. Alright, and which is essentially going to be a function of the difference between the implied forward rate and the FRA. So quite important, guys. I think you should be spending a little more time on the comparison between FRA and synthetic FRA, and how to create a strategy which will help me make some arbitrage profit out of the discrepancy between the two. So let's look at what the third statement of John was, which was an American option put or call could be more valuable than the European option. Would it be? Well, if at all, I would say an American option any day would be more valuable than a European option, because an American option is flexible, could be exercised any day, while a European option could be exercised only on the final day, only at the time of settlement. Now, generally the two options tend to be closely valued or closely priced, but then if the underlying is going to have certain leakages during the intermediate period, that means before expiry, let's say we are talking about an American call and a European call where the underlying is a stock which is going to pay dividend, and it's going to pay dividend in the near term, well before the expiry. Now we all understand that post the payout of the dividend, or let's say on the ex-dividend date, the stock prices tend to go down, tend to be reduced, right? And they would be theoretically down to the extent of the dividend payout. Now that would be bad news for a call holder, because any price decline is bad news, negative news for a call option. Somebody who happens to hold an American call might exercise it way earlier. He might exercise it way earlier than the date of settlement, and then way earlier, let's say before the date when the stock goes ex-dividend. So an early exercise of call could render it more valuable, and precisely under those circumstances an American call would be valued much more than a European call. Now that's one possible scenario in which it could happen. Now, under what circumstances would an American put be more valuable? Now you need to ask yourself, under what circumstances would an early exercise make sense for somebody who's owning a put? Well, clearly when a put is deep in the money, there isn't much more to come your way, being a put option owner, as the stock has already plummeted down to a very low level, and hence you would say, well, when the put is deep in the money, that's when we would look to exercise the put early on, and also because it gives me the advantage of parking that much of money at the prevailing interest rate for a certain period of time, maybe till the day of expiry. I can very well park the money and earn some interest income as well. So clearly in a situation when you have a put which is deep in the money combined with let's say a healthy interest rate environment, a high interest rate environment, well, that could render an American put to be more valuable than a European put. All right, so that I think kind of explains it. We've just tried to identify the situations when American calls and American puts could be rendered more valuable than European call or put. So there we come to the end. Well, that's the closing bell here, saying goodbye to all of you. We're going to meet again very soon, coming up with another 5 pointers or 10 pointers on some area, either to be brought by me or to be brought in by Ankur. So there we would be there. I believe you already would have been part of this series, gone through some important concepts, questions in corp finance as well as FRA, which were brought in by my friend Ankur. And I would very soon be touching upon fixed income, quants, and economics very soon. So till then, goodbye, stay well.